how do we determine chunk payments? So there's a couple of ways that I go about this. So I'm just going to look at your form real quick. All right, the first thing, when someone submits a form, when you guys submit all that information, I'm looking at the 4 numbers, right? How much do I make? What are my expenses? What's my total debt? What's my cash flow left over? Okay. After I get those numbers, now I'm looking at, all right, of all the debts that I have, which one am I paying the most money on? Right? That's one thing. Now I gotta get a little more detail, because now if I have a mortgage, so I'm looking at your thing, we have student loans, we got a car, we got a mortgage. Okay. Next thing in my head is like, okay, what's my debt weapon? Am I gonna use a HELOC from the mortgage? Am I gonna get an unsecured line of credit? Do I have the credit score to get me there? And what happened? What did you get? That's perfect. 5,000 is perfect. We're gonna work with that. I'm gonna build that significantly in the next year. Okay? So the first thing I see, these are your only 3 debts: student loan, car, and mortgage. No credit cards, no crazy. Okay, great. The car, I want to pay off the car first. All right. Psychologically, it's a great feeling when you pay off a car. So by having that motivation, we're going to get there faster. So if I owe $24,718 on my car, my payment's $404 a month, my interest rate's 4.25%. Okay, how far are you in already on the car? Just wonderful, wonderful. Okay. Now, what I'm going to do is I'm going to take your cash flow, that number, and then I'm going to take our expenses. Okay. So we add up all your expenses. Do you have a number, or do you want me to like add it up real quick? What's that number? 3420. Right. So I'm gonna take my cash flow amount, I'm gonna times that by 12. Okay, so I always go conservative. So I'm just gonna say your cash flow is 400. Okay, 400 times 12, that's $4,800. Okay, but I only have a line of credit for 5K, so I don't want to take out the whole amount, right? Only if I want to, right? I've done videos where I take out the whole amount. I've done it myself. When I first started, I had a line of credit for $5,000. I took the whole amount out, right? But if you want to lower your interest costs, you could break up the chunks. All right, so there's multiple ways of doing it. It's more so your preference, right? So let me explain. I can either take a chunk amount of 4,800, okay, and chunk that amount towards the car. So November, come right into November, I can take $4,800, chunk at the car. My next move is to dump my income that I make. So I'm making $4,000 a month. So I'm gonna dump that in, right? What comes out is my 3420 of expenses. What stays in is my 400 cash flow. It'll take me 12 months to zero out the line of credit, and I do it again. All right, that's one way. A faster way is we can break up the chunks, right? Where I can take that 4,800 and divide it by 2. Okay? So 4,800 divided by 2, that's 2,400. Okay, so I'm gonna write that down. 2,400. 2,400 divided by 4, 6 months. So every 6 months, I can make a chunk payment of $2,400. Now, what's nice is if you look at a calendar from January to January, I can make a chunk on January, then in July, and then in January again. That's 12 months, right? So if you did 3 chunks in 1 year, right? 2,400 times 3, that's $7,200. That's more than my $4,800 chunk. And I pay less interest to do so. Does that make sense? So if I'm paying $7,200 straight towards principal, most of it, right? Now you got to factor in the other 9 months, right, out of the 12 of 404, right? So let's add that up. 404 times 9, that's 3,636 plus the $7,200, that's $10,836 1 year. If I owe $24,718, divide that. 24,718 divided by 10,836. 2.28 years to pay off the car, conservative. If I only had $400 cash flow. If I have $500 cash flow, that'll be done in 1.5 years. Yeah. Now the whole idea is every time you make a chunk payment of those 6 months, that doesn't mean you just put back your cash flow of 4 each and every month. We don't want to do that. We want to dump majority of our income into that line of credit. Or you can just select a few certain expenses that you're going to run through the line of credit. Because if I'm only chunking $2,400 every 6 months, obviously I can't put in $4 grand each and every month, right? So what I could do is say, all right, I'm going to run my $1,600 mortgage and the electric for 4, that's $2,000, plus the car payment is $2,400. Does that make sense? So first month I take out 24, pay it towards the car, I satisfy that month's payment, and I lower the interest on the car itself. In that same month, when I get paid, before I use my cash to pay the mortgage, the electric, and the car, I'm going to put that money in the line of credit, which will zero out the balance that same month, right? Now I probably pay like $5 in interest, okay? Then I take the money right back out, put it into my checking account, not all at once. I take out $1,600, pay the mortgage, and then next week pay the electric, and then next week pay the car, right? Well, what's nice, that first month you're not going to have to pay a car because you already paid the car with your chunk. So maybe that 1 month will pick something else to equal the 2,400, right, of expenses. And then at the end of the month you're going to have a cash flow, right, money left over. That goes into the line of credit, whether it's 4, 500. So you figure your balance at the end of 1 month should be like 2,000, 1,900 owed. Does that make sense? So we can do something like that. You're just flipping the money back and forth, and you're avoiding and you're drastically lowering that car. We want to do that when we have a small line of credit, so we can like velocitize it even faster. And what that does is it shows the bank that you're taking out $3,000, paying it right back, taking it out again, paying it right back, taking it out again, paying it right back. Bank's gonna be like, what the heck? She's making all this money, like. And then what that does to your credit score is it boosts it up. And then in 6 months, you're gonna call and ask for an increase to 10,000. Once we get to 10,000, right? You figure 6 months from now, maybe by December you get a raise, or by the new year you get a raise. Okay? That will increase our chunk amount every time we get a raise, or any time we cut off certain expenses, or whatever the case. Okay? So those are some, you know, key ways that I kind of figure out my chunk. I'm looking at risk. I'm looking at how fast can I get to cash flow. Right? Is it smart to try to pay off the student loans first, you know, or the car? Or should I start with my mortgage? It wouldn't be wise to start with the mortgage because you don't have high cash flow just yet, right? But if we killed the car, and then right after we kill the car, we can have like a quick victory on the student loan. We only owe $13,000 on the student loan. A year and a half from now, it'll be less. And then I can potentially pay off the student loan in 6 months or less. Now I get 132 cash flow. 132 plus 404 plus my original 4. Now I'm looking at about 1,000 cash flow. 1,000 times 12, right? 12K a year cash flow. Divide that by 2, 6,000. Do the same thing with the mortgage. 6, 12, 18,000 total going towards the mortgage. Conservatively, that thing should be done in 6 years, 6, 7 years. You know, but if all you did was get $1 raise every year that we're killing the mortgage down, it increases your chunk amount by $1,500. So if you get a $2 raise, increases your chunk amount by $3,000. Right? And the number just gets bigger and bigger in terms of how we chunk. And just make sure when it comes to your mortgage, don't refinance, don't consolidate anything, don't fall for none of those traps. I don't care if they say the mortgage is going to go low or the interest rate is going to be lower. Good. So, anything else? Is that clear? Cool. So we know we're going to tackle the car first.